I'm joined today by Joe Moroney, partner and co-head of Global Corporate Credit and head of Sustainable Finance at Apollo. Joe is among the incredible investors sharing insights at the Private Credit Investment Forum today. Welcome, Joe. It's great to have you with us. Let's dive straight in. What are some of the reasons investment-grade borrowers might seek to raise private capital when they have ample access to public investment-grade markets?
Sure. Well, I think that's a common misconception. While these companies have access to the public bond markets are not always best suited to fill their financing needs. We've provided a number of IG private financing solutions to companies where, in fact, the public bond markets were not best suited to fill these financing needs. Companies need financing for all sorts of reasons. Scaling their businesses, M&A transactions, transformative CapEx. As these companies finance themselves, they really have to think about whether or not relying on one source of capital, the public IG bond markets, or diversifying their financing solutions and thinking about different ways to finance their businesses. Perhaps financing something off balance sheet on a non-recourse basis, using specific assets as collateral, utilizing that as an option incremental to the investment-grade bond markets. And as you think about other sectors like infrastructure, semiconductors, data centers, we're talking about, in some cases, very large borrowing that needs to occur. Doing all of that in the public bond markets can often negatively impact both their public credit rating as well as where their publicly traded debt securities trade, which can negatively impact other public investors. So the private IG market really has emerged as an option for these borrowers that they didn't have before, and a very viable one, we think.
And when considering adding private investment grade to a portfolio, where have you seen clients look to implement it within their overall asset allocation buckets?
Well, we've seen a number of use cases. Endowments and family offices are using private IG as part of a lower risk, absolute return strategy. We've seen fully funded pension funds utilize private IG as part of their de-risking strategy, reallocating to private IG as they de-risk out of private equity, hedge funds, and high yield. But more often, and a growing trend, is we're seeing pension funds actually use private IG as a replacement for traditional allocations, both core and core plus. When you look at core plus, for instance, almost all of the alpha generated from that comes from the plus piece, which is high yield bond exposure. And when compared to private IG, we can deliver a equal or better return with an entire investment grade exposure, which is better for the LP's overall portfolio risk positioning.
So how durable is the spread premium available today in private investment grade over the long term?
Yeah, well, we think it is durable. I think when people ask that question, the implicit references to the middle market direct lending market, where we've seen spreads compress pretty materially over the last several years. I think we think that the spread premium in private IG is more durable because we look to our own book. We've been doing this now for many years, and when we look at the spread premium over publics within our own book, that spread premium has been durable over that time horizon. I also think about competition. One of the reasons that spreads have compressed in the middle market is that the barriers to entry in that market are pretty low. When we think about the barriers to entry in the private IG market, they're pretty high because you have to both bring a very strong structuring expertise to that market, but you also need to be able to cut very large checks all by yourself. Increasingly, $10 billion or more is not an uncommon private IG deal size. And so when you think about the combination of those things, the structuring expertise needed, the ability to cut very large checks, it creates a relatively small universe of credible players that can really scale up in that market. And with a smaller group of credible players, we think it immunizes those spreads a little bit more. Now, we're not naive. I think it's reasonable to assume that some spread compression does occur over time, but really that combination of structuring expertise and scale required to be a credible player in the private IG market, we really think it does limit the amount of spread compression that we're going to see over time.
And what are some of the benefits of asset-backed finance versus traditional corporate debt?
Well, as a portfolio manager, there are several reasons that I like investing in asset-backed securities. First, you're dealing with pools of assets as opposed to a single asset, and that just reduces your risk right off the bat. Second, asset-backed securitizations really allow you to dial up or down where you invest in the capital structure to reflect your risk appetite at any given time. Third is there tend to be amortizing and short duration in nature. That means that they're very cash generative. And when you think about portfolio management, the fact that they're very cash generative really allows us to adjust the portfolio over time, and it makes it much more akin to managing an all-public portfolio. There's other things, bankruptcy remoteness. You know, when there's a lot of risk out in the world, the bankruptcy remoteness of these vehicles and these special purpose vehicles can be beneficial. They're full of covenants and asset quality tests. And so there's a variety of other things, but those are the primary reasons.
And how has regulation impacted the relationship between banks and alternative asset managers?
Yeah, I think regulation has actually driven banks and alternative asset managers together over time. I think there's a popular narrative in the media, that the interplay between banks and private lenders is a zero-sum game. But from our perspective, that couldn't be further from the truth. If you just look at the market over the last year, there have been 12 different announcements where banks have paired up with private lenders to further push the private credit market. Just ourselves, in September, Apollo announced an agreement and a partnership with Citigroup where we committed to deploy together $25 billion in private credit over the next 5 years. And so I really think you're likely to see additional announcements like this and more partnerships that is really only going to further serve to make private credit a viable option for a broader range of borrowers.
Joe, thank you. We're going to have to leave it there and get back to the forum, but I really appreciate you sharing your expertise with us today and for being a part of Global Investment Institute's Private Credit Investment Forum.
Thank you for having me, and appreciate your time.